Welcome back to another video, YouTube family. It is good to be back, and I am back with a special video. In this video, I'm going to be breaking down my exact strategy that has made me profitable, that has gotten me funded over 7 figures, and that's allowed me to become a full-time day trader. If you've seen my live streams that I host here on YouTube for free, or if you've already studied ICT, the 2022 mentorship, a lot of this might be familiar to you. And if you haven't studied any ICT whatsoever, I highly recommend you go through at least the 2022 mentorship, or this might not make a whole lot of sense. But without further ado, let's go ahead and jump in. I'm going to break down this model in its entirety so you can understand the 3 different parts. Then we're going to go ahead and dive on the charts, look at some examples, and show you exactly how I hunt for setups on a daily basis. So enough yapping, let's go ahead and dive in. All right, so diving right in, whenever we're talking about an ICT-based model, we are always referring to 2 things, time and price. Without time, price cannot do its thing. And without price, well, there's no point in even having time on the charts. So these 2 things coincide together. The primary one you want to focus on first is time, and that's why we're narrowing down our session. Now, I primarily focus on the AM session, which is 9:30 opening bell to 12 p.m. lunch hour. And within that session, I usually tend to focus on the 9:50 to 10:10 macro and the 10:50 to 11:10 macro. Sometimes the 11:50 to 12:10, but very rarely. Just because we have these macros does not mean I'm always taking positions during these macros. If it happens to align with it and we have a valid setup, I just see it as an extra confluence. But if I see a setup form at 9:35, 9:45, and it's valid, we have all the confluences, I will still take that setup. You can also apply this strategy to the PM session, Asia session, as well as London, and they all have their respective kill zones. For the sake of this video, I'm only going to cover the AM session, but just so you know, you can apply it to these sessions as well. And now that we've got time out of the way, we can move on to what I'm looking for within actual price. So in terms of what I'm actually looking to see in price action, it can be broken down into 3 different categories: higher time frame bias, intraday points of interest, and lower time frame entry confirmations. And these 3 things are what make up the price aspect of my model. In terms of importance, the higher time frame bias takes precedence over any other narrative. So the things that are happening here overtake anything that happens on the intraday, lower time frame. So it's best when you have all of these 3 aligning, but in some instances you will not have a clear higher time frame bias, and in that case you can always use the intraday for bias as well. Now, when you don't even have an intraday bias, so let's say the intraday charts are completely choppy, in that case it's probably best not to trade. So just in case you're wondering, you don't always need a higher time frame bias, but your best trades, your biggest risk to rewards, are going to come from the days where you have the higher time frame bias supporting your entry. Now, what is higher time frame? What is lower time frame? What is intraday? In terms of higher time frame bias, I always start on the weekly chart, and then from there I move on to the daily chart, and then from there I'll look at the 4-hour. At a minimum, for a higher time frame bias, you need at least a clear bias on the 4-hour chart. Now, in terms of intraday time frames, we're going to be looking at the 1 hour and the 15-minute. These are where I find most of my entry PD arrays on, my points of interest, and it's also where daily, 4-hour, and weekly levels are also going to align with some of these PD arrays sometimes, and it just gives you extra confluence. Now, in terms of lower time frame charts, the main ones that I use are the 1 minute and the 30-second. Now, the 30-second is a bit risky, so if you're a beginner, I would focus on the 1 minute and the 5 minute, but most of my examples are going to be on the 1 minute and sometimes on the 30-second. And the way this process works, you basically go top down, so top down analysis, multi-time frame analysis, whatever you want to call it. Now that we've covered time and price, we're going to go ahead and jump into my actual daily analysis process that I use on the charts every single morning. So starting on the higher time frames, this is what I'm doing every day to mark out my levels. So the first thing I'm doing, I'm marking out the previous day's open, high, low, and close. The next thing you're marking out is any swing highs or swing lows that are obvious. If there's any obvious points, we can use as draws on liquidity, you want to mark those swing highs and lows as well. Other than that, you want to mark PD arrays, fair value gaps, order blocks, inverted fair value gaps, volume imbalances, liquidity voids. All of these things are PD arrays. If you don't want to use all of these, you can simply pick one or two. After you've marked out all of these levels, you should have a pretty good idea of if there is a clear higher time frame draw or not. In other words, do we have a clear higher time frame bias, or is price too clunky, too compressed together, or too unclear or choppy for us to determine that? If we have a clear bias, expect higher probabilities. Your trades could probably go to daily targets. You can probably leave a lot of runners. If no, expect maybe some lower probability. If the intraday chart isn't clean, you may see no trades at all. And if the intraday is clean, you may see some good setups, but they might not run for those daily or weekly levels. So at that point, it's up to your own discretion whether you want to continue trading or not if you do not have a higher time frame bias. Next, you want to move on to your intraday analysis. So you're dropping down to your 15-minute and your 1 hour time frame charts. Once you're on these charts, the first levels you're going to mark out are London high and London low. And if you don't know what these levels are, it is simply the highest high and the lowest low that has been formed between 2 a.m. and 5 a.m. of the previous day. Price likes to use these levels to decide the trend for New York session. Along with that, you're marking out all the PD arrays as well, anything that you can potentially use for an entry. And last but not least, you're going to draw out your equilibrium. That is the 50% point, so you can do that with the Fibonacci tool. And you're going to take the most recent displacement leg, or you're going to take the range. And it's also important to note, whatever point of interest you have when you're selling, you want that point of interest to be in the upper half of the 50% relative to the 15-minute or the 1 hour. And if you're going to take a buy, the best buys come from under the 50% level down here in a discount. So up here is premium, down here is discount. And if you've been losing a lot of lower time frame entries, this is probably the reason why. But from there, as soon as you've marked your levels, you're simply trying to determine, is there an obvious entry point of interest? If the answer is yes, you can drop down to the lower time frame. If the answer is no, you simply need to wait for displacement. So you need to wait for that 15-minute time frame to develop some new structure. But if you have that entry point of interest and price is trading to it, you can go ahead and drop down to your lower time frames where the final piece of the analysis happens. This is what decides whether you actually put money on the line or not, and if that entry point of interest that you so patiently waited for is going to end up delivering a setup. As soon as price gets to whatever, the high, the low, the fair value gap, you're looking for one of two things. You only need to see one of these. You may end up seeing both. The first one is a market structure shift with a fair value gap, order block, or both. And we're going to get on the charts right after this, so don't worry, we're going to get into some examples. You want to see price respect this level. You also want to see us form some type of swing high if you're buying, some type of swing low if you're selling. So we swept liquidity here, we made a swing high. Now we're looking for price to break and close above that swing high with displacement. Keyword is with displacement. If it's just a wick, if it's just a small weak candle, not much of a run, you are most likely only trading noise, or you're just trading a short-term sweep of a high to go further down. Usually when it does this, it's going to leave an order block. So you're going to have an order block down here, and you also want to see it leave a fair value gap. So if you get those two things, or even if you just get a fair value gap or just an order block, that is a valid setup, and you can go ahead and enter stop loss. If you're a little bit riskier, it's going to go below the fair value gap candle. If you want to be safe, you can just put your stop under the low, but that is the market structure shift. Number two, change in the state of delivery. This is an IFEG or order block getting disrespected. I only use the IFEG. So what are we looking for in this case? Well, we see price come down into this level. Maybe it leaves a swing high or something, and then it leaves a bearish fair value gap. So you might look at that initially and be like, oh, I'm going to go ahead and get in there and sell. But we swept a liquidity level on the 15-minute or above time frame. So if this fair value gap gets traded and closed above, that is an inversion fair value gap. It has to close above. It can't just wick. And it's even better if it closes slightly above your last swing high, because then you're getting a market structure shift and a change of state of delivery at the same time. As soon as this candle closes above your fair value gap, you can put your stop loss either under the low or the fair value gap candle, and you can ride it out for the rest of the move. So you either want to see one of those two scenarios play out. After that, is there a clear displacement and a target of at least a 2R? If yes, you can enter, and if no, then you need to wait. And what does this mean? Well, let's say you have a inverted fair value gap set up down here, but let's say there's also a bearish fair value gap somewhere, and the bearish fair value gap on the 15-minute time frame just happens to be resting above your entry. So even though this is a valid inverted fair value gap for a buy, because we have this bearish 15-minute fair value gap, you're not going to get a 1 to 2 before price has the potential to come down and get you out of that entry, because we ran into a higher time frame gap. And now that you understand this, I'm actually going to hop on the charts, do this exact analysis process in front of you, and we're going to find the setup right here in real time. So we're on the charts now, and I'm on the weekly time frame. So let's start from the top. I already have a weekly order block from down here, and it looks like another order block here is forming. So I'm just going to go ahead, copy and paste this bullish order block level. Another thing I like to do is use my Fibonacci tool to mark out the mean threshold. So I'm going to mark out both the order block, and from the open to the close, you're going to take the 50% level of that, and that is your order block mean threshold. We did take this weekly high, so I'm also paying attention to this level. So swing highs, swing lows, you remember we're marking out. This would be an example of a weekly swing high. But based on what we're seeing, either this order block is going to hold and we're going to continue making new highs, or this is going to close past this order block and we can see maybe a weekly market structure shift. But that is my analysis on the weekly so far. Going to drop down to the daily time frame now. Now on the daily time frame, remember we're marking out the open, high, low, close of the previous day. I already have templates drawn out for this, but this is basically what I'm doing. I'm just taking these levels and I'm marking them out on the daily time frame. So this is the first thing that I do on the daily. So now that we've got the open, high, low, close marked out, I'm going to start marking out these different PD arrays. But you see how we swept that weekly. That weekly is transposed to the daily, and we also have our weekly order block transposed to the daily as well. So right off the bat, what I'm noticing is we have this daily bullish fair value gap right here, and we also have another daily fair value gap down here. And below we also have a daily order block, but we have the weekly order block marked out, so I'm not going to mark that one out right now. The last thing I'm going to do is take a equilibrium measurement, because we had this big bullish displacement on the daily that created that order block, also happened on the weekly, so it would make sense for price to want to retrace to at least the midpoint of this from a higher time frame perspective before deciding to go higher. So in maybe the longer term, we can look for a retracement all the way down to this level, but for now I think we can reach for the midpoint of this daily gap, and if we want to continue selling off, we can probably reach all the way for this daily fair value gap. So let's go ahead and drop down into the 4-hour chart. We have this 4-hour bearish fair value gap right here, and it looks like price has sold off of that fair value gap, and we also have a bullish fair value gap down here on the 4-hour, but we also have that daily, so we don't have to draw that one out right now. Now along with this, we also just swept highs, and we have these relative equal lows down here, so I think if we end up respecting this 4-hour gap, we can hunt these relative equal lows and get further down into this area. Now that we've got that marked, what I'm actually going to do is I'm going to fast forward to AM session of the next day, and then we'll drop down to the 1-hour and we'll fast forward to around 9 a.m. So we're right at 9 a.m. here on the 1-hour candle. The 4-hour bearish fair value gap is still being respective, and it looks like we're going to go lower to take these relative equal lows. So now that we've marked out the higher time frame levels, what we need to do now is mark out that London high and London low. So going back to that intraday analysis process, 2 a.m. right here, so that's London low, and then up here is London high. So we've got London high up here, London low down here. So I'm going to go ahead and drop down to the 15-minute time frame. And on the 15, you can see we got 9:30 open right here. This is what we'd be looking at the start of our session. So what do we notice right here? We're in a range from the top of this London high to the bottom of that London low. And you can see within that range, we have delivered up, retraced, tried to go higher, couldn't go higher, and we also displaced on the 15-minute. So the last price leg on the 15 is a bearish leg, and it's from the top top of that order block all the way down to that low. And if we're bearish on the higher time frames, what do we want to see? We want to see a PD array that we can use as an entry point of interest, form in a premium for sells, and a discount for buys. What do we have right here? A 15-minute bearish fair value gap. This is looking like a really good point of interest. If we want to get that New York continuation profile, we leave London high intact, retrace to a premium, and then deliver and hunt London low. Another potential scenario, since we are also in a bullish 15-minute gap, we could potentially see price develop a entry down here and go up. However, we already rebalanced this pretty well, so I'm thinking this level is going to be pretty weak. I can also mark out this 15-minute order block because we do have this as well. So we do have a bearish order block, and then up here would be the order block mean threshold. So we got those two levels mapped as well. So now we can drop down to the lower time frame charts. So I'm going to go ahead and pull up the 1 minute here, and then market open is at 9:30 here. So let's see if there are any entry opportunities still supporting my bullish or still supporting my bearish theory on price today. Let's see if it develops anything. If this fair value gap inverts right here, this can maybe be an inverted fair value gap setup. We'll see here. Looks like it respected that fair value gap, still wants to go higher. We have another fair value gap right here, which is looking even better after sweeping some of those highs up there. So if we see this bullish fair value gap get inverted, it will be a change in the state of delivery, meaning we can take an inversion fair value gap sell. But what do we see here? Even though we wicked past our level, we're respecting the bodies on the close. So that's what you want to see. So let's see how this plays out. And you see we finally get the inversion fair value gap. So at this point, I can go short. I can place my stop loss above the inversion fair value gap candle. If you want to be extra conservative, you can go above the high. And I'm actually going to target London low down here. We have the change in the state of delivery, so we can go ahead and test this out. Straight to delivery, and you see it runs even past that target. Hopefully this is starting to make sense. This is one of those textbook scenarios. We had daily time frame bias aligned with intraday bias, aligned with New York continuation profile, along with a bearish inverted fair value gap. This is a textbook A+ day. And if we go up to the 15-minute time frame, you can see how this played out here. Beautiful. And you can also see how it played out on the other time frames as well. So beautiful respect of all that. Touch that CE of the daily fair value gap, and you could see how it closed on the daily as well. So we weren't too off in terms of our target. If you notice too, we also swept the open price of yesterday's candle and then started to deliver lower and hunted the low as well. And real quick, let's go over this other setup from earlier in this same week. I've already got the open, high, low, close marked out. Same draw, same higher time frame bias. So I'm going to go ahead and drop down to the 4-hour chart. And then what we can go ahead and do is just fast forward to that same time frame. And we still have this 4-hour fair value gap here that aligns with our bias. So even though this is earlier in the week, we would have still been using this 4-hour fair value gap. Now, in terms of the 1-hour chart, we have had a bearish sell-off. We're consolidating down here. Let's go ahead and mark out London high and London low once again. We got London high up here, and we got London low down here. So it will be interesting on this day if we see the same scenario, or do we take London high and then reverse on this last move? So in other words, do we get a New York reversal profile for this session? Let's go ahead and drop down to the 15-minute charts. And on the 15-minute chart, we can see we have a fair value gap up here as well. I'm thinking we may see a sweep of London high based on where we are, and it's going to dig into this gap. And if it reverses, we can probably see it hunt London low. If it continues, we'll probably see London low be intact, find support of this order block, and run through these levels. I'll go ahead and mark out this 15-minute order block. That is our opposing PD array currently, and we're going to go ahead and drop down to the 1-minute time frame. Market opened, see a nice, looks like we're going buy now. And now we have swept London high right here. So we have officially swept London high. Let's see if price decides to create a setup off of this. We have this fair value gap here. So if that inverts, that could potentially be a setup. And there we have an inversion right there. Typically, you would be able to take a sell. And I know what you might be thinking. Yeah, you're going to get in this IFEG right now. You gave the confirmation, swept the high. So what more do we need to wait for? Well, if you guys do remember, we still need to have a 1 to 2 through to our closest target. We have that order block on the 15-minute right here. So that's the first level. This is the mean threshold. So we would have less than a 0.38 R. But we also have to consider, we dug into that order block, respected it, and we broke structure to the upside. So this actually is looking more like a 2022 model buy. The only problem with this buy is, again, guys, and this is where it gets kind of interesting, we need our stop loss down here. By the time we get back up to London high, which is the reversal point, and even to that 4-hour gap, we don't even have a 1-to-1. So even though we're getting confirmation in both places, we can't take a setup because it is invalid. So let's let price play out a little bit more. At this point, I'm still paying attention to the same levels, but I want to see a little bit more price. Looks like we're going even higher in that level now. So we've swept what looks like to be yesterday's open price. This could be a place where price wants to reverse. So let's see if that's the case. And we did. We get a nice displacement. We don't close below this swing low, but if we check on the 30-second time frame, we in fact did break the most recent swing low that left that high. We already got this fair value gap up here. We got the displacement. We closed below, we got a market structure shift, and we also took liquidity up here, and we left a fair value gap as well as this big order block right here. I can go ahead and take my short. Stop loss in this case can either go above the fair value gap candle or above the high. And now what do we see? We see that we have at least a 1-to-2 back to that order block. Well, actually, this is the order block, so we actually have a 1-to-3. Booked straight to target. So hopefully you guys are starting to understand this now. Hopefully you're also understanding when to enter versus when not to enter, because if you would have taken this buy, yeah, you would have got some decent profit. And if you took that first inverted fair value gap sell on the 1 minute, you would have been stopped out. In either of these cases, the risk wouldn't have been worth the reward. You would have been out at a 1-to-1 here or at less than a 0.3 before stopping you out. Whereas we waited for the sweep, we waited for price to put some distance in between this PD array and our opposing target, and this was all in alignment with the higher time frame narrative. So if you check the 15-minute time frame, you could see we swept that London high. Now we're going, and we took the London low. So that was a New York reversal profile on the 1 hour and the 4 hour, just so you can see. Very beautiful day, and you could see the daily bias was correct as well. Smaller candle than usual just because we swept the weekly level, but still a bearish candle nonetheless, and still was able to capitalize on that move. And let's go ahead and go over one more example before we dive into some more advanced concepts. As we can see a little bit later in the week now, we have retraced to that point that we said we were going to retrace to, and you can see now that we're in a discount, now that we reach for that weekly order block, we're finding some support there. We also have this daily fair value gap here, this daily bearish fair value gap, and we have also created a daily bearish fair value gap up here as well. This is also an inverted gap, but it lines right up with this gap, so I'm just going to keep this one here for neatness sake. At this point, I'm thinking we can reach at least for that consequent encroachment, and if we're able to pass this gap, we can reach for this one as well. Now that we've also found support on the weekly, I'm thinking we can see an extended run. So let's go ahead and drop down to the 4-hour time frame, and we can go ahead and mark out the rest of this chart. We have inverted this 4-hour gap now after taking the weekly order block. So at this point, we have a bullish 4-hour fair value gap here, and then we also have a bearish 4-hour fair value gap. This also aligns up quite nicely with the daily fair value gap, so I probably won't put this one on, but we'll just note that it's there. We have a 4-hour order block right here as well, and so now I'm going to go ahead and fast forward to our session. And at our session, we ended up being at this 4-hour order block, so I'm now going to mark this out. What I'm seeing is either two scenarios. Either we hold this order block and continue up. You can also use your fib tool because we had this huge displacement down, so now we can probably either see it sell off from here at the midpoint or retrace for an even more premium price. We're going to drop down to the 1-hour chart, and what do we notice here? We notice price actually has another order block. So we have that 4-hour order block, we have the mean threshold that lines up right with that order block, but we also have the 1-hour order block mean threshold that could potentially be a level that price wants to use. We're not going to mark out the top level simply because we already have that 4 4-hour level there. Along with that, we can mark out London high and London low. It looks like London high was up here, so London high has already been taken, and then London low was down here, so London low has already been taken as well. So whenever that happens, you don't really have to mark it if both levels are taken and if it's already traveled pretty far away since then and we have fresh price. But we are going to go ahead and mark out this 1-hour order block right here. So it looks like we've already sold off from that level. So if we end up coming back to this level, may not be as strong. So you can see we have both of those levels marked. We also have the order block marked down here. So at this point, it is kind of a battle of the order blocks. On certain days like this, you're not going to have as clear of a higher time frame bias, and it's not going to have as much distance to go. So you kind of have to rely on the most recent intraday price action. So let's go ahead and drop down to the 15-minute time frame. We have this fair value gap right here, and then we also have these fair value gaps up here, but we don't need to mark those. We're going to drop down to the lower time frames again, and we're going to see what price does when it starts to reach for some of these levels. Right now, we are at that 4-hour order block mean threshold. We've already gone past the 4-hour order block level, so let's see if we get some respect here. Doesn't look like it. We're still continuing. So the next level is this weekly order block, and we also have that 1-hour order block mean threshold that we outlined. So let's see if anything happens when we reach for that level. We're down there. Looks like we're respecting it to a decent extent. Have not touched the 1-hour order block mean threshold yet. There it goes. We touched the order block mean threshold, and you could see we finally get a market structure shift. We have also left an order block as well as an order block right here. So as soon as price trades back to this order block area, we can go ahead and take our entry. And if we look on the 30-second time frame, we could see that price has created an inversion fair value gap. So you could have also got in on that inversion fair value gap, but I'm going to go ahead and go off the 1-minute confirmation. So I can go ahead and place my long position, stop loss. I'm going to put below this candle, and I'm going to go ahead and target a 15-minute equilibrium. We're going to go ahead and take this drop, and I'm going to target that midpoint right there on the equilibrium. Let's see how this plays out. And you can see beautiful delivery to that target. Now, usually you would not want to see it close past all of this. This would usually be bad. The only reason why this played out is because down here, we actually also had higher time frame levels. If you look real close at the daily, you can see that we had this volume imbalance. So this volume imbalance has been keeping us supported on the daily time frame, and it's going to be interesting because when we drop down to this lower time frame, you're going to see how well this transposes. And look at that beautiful respect of that level. So the more of these things you can stack on top of each other, the better. But now that we've got the basics out of the way, let's go ahead and move on to some of the more complex stuff, some of the common mistakes and pitfalls that you're going to want to avoid in order to trade this strategy with the maximum win rate and maximum profitability. The first one is entering without an intraday point of interest, meaning you just enter on the lower time frame without a 15-minute fair value gap, 1 hour, daily, whatever the case is. You're simply just trading on the lower time frames without an entry point of interest. This is probably one of the best examples I can find of this. As you see, price came up to take some highs, and we have created what seems to be an inversion fair value gap. We swept a high, we inverted a bullish gap, so we should be able to sell this now, right? So let's see what happens here, and we got stopped. Even though we had a sweep, we had an inversion, so why didn't it go down? Well, let's check out another one. Price comes up, creates a fair value gap right here. So if this fair value gap gets traded through right, we should be able to go in for an IFEG sell. We get that inversion, so now I can go ahead and place my sell right here, stop loss above the inversion candle, and I could go ahead and then target the lows here, and I get stopped out again. So why do I keep getting stopped out? It's because if you zoom out to the 15-minute chart, what's actually happening is price is leaving relative equal highs. So all of these false runs we get are simply leaving these relative equal highs, and then where does price want to go? It wants to reach up into this 4-hour fair value gap and this 15-minute fair value gap. Price has wicked up into that 15-minute and 4-hour gap. So now we have a fair value gap here, and if this inverts, we can go ahead and take our entry. Fair value gap has inverted. I can go ahead and take my stab short, stop loss above the inversion fair value gap candle or the high, and now I can go ahead and target these same areas. And you can see beautiful delivery straight to target. So this is a good example of us failing inversion fair value gaps, failing our entries because we haven't waited for the entry point of interest on the 15-minute chart or above. So if you keep getting stopped out on your entries, if you keep losing entries, that's probably why. The second common mistake is entering without a minimum 2R. And we just saw that in one of these examples that we went over, but we'll go ahead and go over another one. Here's an example of a 2022 model setup. As you can see, we had that market structure shift there. We had a sweep of liquidity in a bullish 15-minute fair value gap, and we've also left a 1-minute fair value gap in an order block. So this should be everything we need to go ahead and take a perfect 2022 model entry, right? Stop loss below here, and then this should just play out right away. But we see we get stopped. So why did this trade not play out? Well, to find that out, we have to zoom out once again. And what do we notice here? Right where we were trying to buy up into is actually a 15-minute bearish fair value gap. So in terms of meeting the minimum risk to reward, we only had about 0.64 out of 2R. And even if we were to target the midpoint, that's only a 1.3R. So in this case, we had the perfect setup, and had this gap been right up here or so, where we can target this with a perfect 1 to 2, this may have played out. But because we were already in this gap, by the time we got this confirmation, we have also confirmed an IFEG sell. So price traded up into the 15-minute, went ahead and changed the state of delivery right there. So if you would have got in around there, stop above the high, you can actually short this all the way down, and you see it just ends up dumping. So that is another example. And in this case, we did not have the minimum risk to reward. You need at least a 2R, and it's never good to see two 15-minute opposing gaps crowded next to each other. When that happens, you most likely always will see a lot of back and forth chop. And on to the third common mistake that I see, buying at a premium and selling at a discount. As a trader, we want to always be buying at a discount, selling from a premium relative to at least the 15-minute time frame. And this even applies on the lower time frames as well. We can also use this exact same example. So if we zoom out and pay more attention to this buy, let me extend it so it shows on all the time frames. That buy was way up here. So if we take the most recent 15-minute price leg from down below at this low to this high, we can see that a discount is down here. So we'd only want to be buying under this section versus up here, we're way at top at the premium, which is why you saw that sell play out so nicely. So let's see what happens when price reaches for that level. You can see we reach for a discount, and at that point, you can see we start to buy up and actually take that high. And what's going to be crazy, let's go ahead and zoom into a 30-second chart. Let's come all the way down here where price reached for that discount. And what are we going to see right by that order block mean threshold? The 30-second time frame actually left an inversion fair value gap. So you could have got in right there on that inversion gap. Boom, stop loss below the gap candle or the low, and you could have targeted this 15-minute fair value gap up here, and price would have booked your target by the end of the day for a nice 1 to 7. So you're seeing how this works. You do have to wait it out to an extent, especially with these intraday points of interest. Any other moves that happen in between are either short-lived or stopped out right away. So always want to be buying from a discount, selling from a premium. The next mistake is trading during consolidation profile. As we discussed, there's New York continuation profile, New York reversal profile, but the ones you want to avoid are consolidation profile and seek and destroy, because this is where it is most common to get stopped out, and this is also where your intraday points of interest are going to be the least clear. And to understand this, I've pulled up one of the most classic days for consolidation, which is the day before CPI. The AM session before CPI day is usually just chop ridden, and you can see that same thing here. So even though we have London low down here, we've got London high up here, and we've got a couple PD arrays, we've got this 15-minute bullish gap right here, and we've got a couple bearish gaps as well, but none that are really relevant. We've just going back and forth. We also have this order block here, but we didn't respect mean threshold. So when we drop down to the lower time frames, you're just going to see it's just a lot of chop. We went into this fair value gap once, displaced, couldn't break the high, came down, we came up to the high, couldn't break the low, came back in. So whenever you see price not moving to the external high or the external low, you know that it is consolidation profile, and everything within here is just pretty much 50-50. You can get in on some of these moves, take profit on the internal liquidity, but in terms of finding full moves or even finding a solid PD array to tee off of, you're not really going to get that. So that's one of the ways you can determine consolidation. Another way is when candles are closing side by side. So whenever that happens, you just need to wait for displacement. It gives you new PD arrays like this gap, and it either plays out or it fails. And the last common mistake to consider is not waiting for displacement. So this could either be from your IFEGs or your 2022 models. As we can see here, price has swept these lows down here, giving us some liquidity, and it also looks like price has made somewhat of a market structure shift. We also left an order block. We should be able to long this when it gets back down here, stop below here, and target the high. As we can see, stopped out almost immediately, and it's because although we had a break of structure here and a closure, we did not have full on displacement. And how do you tell the difference? Well, a lot of it has to do with how the candles are forming in real time. Unfortunately, on market replay, we don't get to see the actual speed. But it also has to do with how energetic and how many candles displace, how far it displaces, and if it leaves some fair value gaps or imbalances to get in. So let's see if we can find another example of this. Now it looks like we might get some displacement. We technically broke this high, so that is a market structure shift again. And we also took the lows, so we should have some liquidity now, right? So why then, when I put this fair value gap trade in, then why do we continue to just chop around again? Now, it doesn't actually stop me out here, but what you're about to see will make this displacement lesson a lot clearer. Now, what do we see? Actual displacement, an energetic run. Even here, because we left a fair value gap after a break of structure, this still was valid, but you did not have displacement, which is why you sat in all of this drawdown, and it's a miracle you didn't get stopped out. But now let's look. We have this displacement leg, so now price can finally start to run higher. So if you're making this mistake, chances are you're just not being patient enough, and you're jumping the gun on the first market structure shift that you see. And that just about wraps it up for today's video. Appreciate you guys watching, and if you have any questions about this model, or if you enjoyed this video, feel free to drop a comment in the comments below. Also, be sure to join the free Discord if you haven't already. The link is in the description. I do free Q&As, free daily analysis, and there's also a ton of traders in there as well. I also dropped a free PDF guide breaking down this exact strategy, so if you want that to reference while you're trading, while you're doing your study, I put that in the link in the description as well. And until next time, guys, go out there and make some money with this strategy, and I'll see you in the next one.